The Bogleheads 4-fund portfolio is globally diversified across stocks and bonds. Here we'll investigate its components, historical performance, and the best ETFs to use in its implementation. The Bogleheads 4-fund portfolio is simply the Bogleheads 3-fund portfolio with the addition of international bonds. The theory and mechanics underlying the composition of the 4-fund portfolio is the same as that of the 3-fund portfolio. For the sake of brevity in this video, I won't be going into the benefits of index funds here, but I did that in a separate video on the 3-fund portfolio. You also probably already want to use index funds if you've arrived on this video. The Bogleheads 4-fund portfolio, as the name suggests, is comprised of 4 funds capturing US stocks, US bonds, international stocks, and international bonds. This gets you fully diversified globally across all styles and cap sizes for stocks and bonds. Let's look at the specific assets. At global market weights, US stocks only comprise about half of the global market. International stocks don't move in perfect lockstep with US stocks, offering a diversification benefit. If US stocks are declining, international stocks may be doing well, and vice versa. No single country consistently outperforms all the others in the world. If one did, that outperformance would also lead to a relative overvaluation and a subsequent reversal. The legendary Meb Faber found that if you look at the past 70 years, the US stock market has outperformed foreign stocks by 1% per year. But all of that outperformance has come after 2009. Excluding stocks outside the US means you're missing out on leading companies that just happen to be based elsewhere. Similarly, there have been periods where a global portfolio outperformed a US portfolio. During the period 1970 to 2008, an equity portfolio of 80% US stocks and 20% international stocks had higher general and risk-adjusted returns than a 100% US stock portfolio. In short, geographic diversification in equities has huge potential upside and little downside for investors. Just as with the 3-fund portfolio, here I've set international stocks and international bonds at 1/3 the allocation of their domestic counterparts, because most people prefer to overweight the US, which is called home country bias for those who live in the US. Assuming a retirement age of 60, a general rule of thumb is to use age minus 20 for bond allocation, obviously titrating up or down based on risk tolerance. Given that, for the sake of simplicity in this video, let's assume a starting age of 20 and a retirement age of 60, yielding an average investor age of 40. Based on that, a one-size-fits-most 80-20 allocation for the Bogleheads 4-fund portfolio for the investor wanting to overweight the US is as follows: 60% US stocks, 20% international stocks, 15% US bonds, and 5% international bonds. Now let's look at historical performance. My data for the total international bond market only goes back to 1999, so the backtest here is for the period 1999 through 2021, comparing an 80-20 Bogleheads 4-fund portfolio to the S&P 500 index. Given the short time period, returns are pretty close, with the 4-fund portfolio having a higher risk-adjusted return from lower volatility and smaller drawdowns, as we would expect. M1 Finance is a great choice of broker to implement the Bogleheads 4-fund portfolio because it makes regular rebalancing seamless and easy, has 0 transaction fees, allows fractional shares, and incorporates dynamic rebalancing for new deposits. Using entirely low-cost Vanguard funds, we can construct an 80-20 allocation of the Bogleheads 4-fund portfolio pie like this: VTI at 60%, VXUS at 20%, BND at 15%, and BNDX at 5%. I'll provide a link in the description for this pie to use in your portfolio on M1 Finance. What do you think of the Bogleheads 4-fund portfolio? Let me know in the comments. Thanks for watching.